Welcome everyone. My name is Hiram Cherez, co-owner of Day Trade Smart, and this is the sweep. We're going to get started right now. Alright, so as always, like, share, and follow on social media. There are our social media links, so feel free to jot those down or pause the video, whatever you'd like. Of course, you can also reach out to us via our email, info@daytradesmart.com. Alright, let's go ahead and get started. So first thing, let's go over some Forex news. So this is actually not July 5th through the 9th. I apologize. Let's go ahead and go to our source for Forex news. We're going to use forexfactory.com. And on Sunday, so it actually starts on Sunday this week. We do have some announcements on Sunday, but they're all yellow announcements, right? So they're low impact announcements, not anything to be too concerned about. Let's go to the next day. This is going to be Monday, August 2nd. And a lot of yellow announcements again. You can see that orange here for German final manufacturing PMI. And that one's middle or medium impact. You got bank holiday for the Canadians. And then we've got a red announcement here at 8 a.m. Mountain Time. So this is going to be 10 a.m. Eastern. And that's ISM manufacturing PMI. And again, if you don't know what some of these things are, just click on the little folder and it'll give you a rundown of what they are. You can look at how what happened in the market historically as a result of the announcements that you see right here. The last one, July 1st, 2021. The forecast was for 61 and it came out 60.6. You can go back to that date and see what the market did, right? How it reacted to that. Forecast for Monday will be a small increase, right? We're at 60.6 and it's at 60.8. So that should be, if it comes out that way or higher, that'll be better. That'll be good for the currency pair. Otherwise, sometimes even if it's the same, where in this case the same, or it's the same as the forecast, it would be better than the previous. So that would actually be good for the currency, in this case the U.S. dollar. Okay, and then down here, 10:30 p.m. So this is going to be 12:30 Eastern time. So 10:30 p.m. Mountain time. Australian dollar has Rba Rate Statement. So again, this is similar to our FOMC interest rate. So you can definitely expect that you'll see some volatility at that time. It looks like they have no plans of increasing or decreasing their cash rate. So a lot of times, even if it comes out at 0.10% like it's forecasted and there is no change from the previous, you can still see volume and volatility in the market. So keep an eye out for that one. Those are going to be the two you're going to want to watch on Monday. Tuesday, we've got medium impact Spanish unemployment change, so not too big a deal. That's going to be 1 a.m. Mountain, 3 a.m. Eastern. And then down here at 4:45 p.m. Mountain or 6:45 Eastern, employment change quarterly, and then unemployment rate for the New Zealand dollar. Keep an eye out for that one. And then Aussie has retail sales at 7:30 p.m. Mountain, 9:30 p.m. Eastern. And that'll wrap up Tuesday. Let's go to Wednesday. Wednesday, keep an eye out for this one, 6:15 a.m. ADP non-farm employment change and ISM services PMI. These are both U.S. dollar announcements. You can see the FOMC member is speaking, but it's a yellow announcement. So a lot of times when it's a yellow announcement, there's not, the topic is not a hot topic. Excuse me, and they're not, and audience questions are expected actually here. So that's kind of interesting that it's a yellow announcement. I would say be on the lookout for this one. You want to be careful with something like this where they're yellow announcements, and this could be because this chair person they just may not be, or sorry, this is not the Fed chair, they're just a member of the FOMC, and they could just be like a lower level member, and so traders not really looking to see what they're going to say to make their decisions what to do in the market. So that could be the case, but just in case you want to watch out for that. So we talked about ISM services PMI, and then crude oil inventories. This is going to be 8:30 a.m. so Mountain, 10:30 Eastern, and we don't have a projection yet, which is Pretty common because it's still early. So keep an eye out for this one as Wednesday approaches, and then you'll get a forecast. And you want to see this number be high because that you'll feel the impact at the pump, right? So if we have a lot of inventory, then gas prices will go lower. If we have very little inventory and it's more scarce, then gas prices increase. Okay, let's move on to Thursday. Thursday, we've got quite a few red announcements. So we've got asset purchase facility for the Great Britain pound. This is 5 a.m. Mountain, 7 a.m. Eastern. BOE monetary policy report, and then MPC asset purchase facility votes, monetary policy summary, and then bank rate votes, and then official bank rate. Check this out. The monetary policy summary is a red announcement where the actual bank rate that comes in at the same time is a medium impact. So that's kind of interesting. So keep an eye out for that stuff. And by the way, I always recommend, even though we're kind of going over it right now, I'd recommend looking at it every day, just in case you forgot something. In addition to that, sometimes other things will be added, and folders or impacts will be updated. So this could very well turn into a red announcement, or others may turn into yellow, or or the like. So I would recommend checking this every day. Okay. RBA Governor Lowell speaks. That's for the Australian dollar, 5 p.m. Mountain, 7 p.m. Eastern. So keep an eye out for that one. And that will bring us to Friday. Friday, we've got a lot of red announcements here as well. So 5:15 a.m., we've got Great Britain pound, 5:15 Mountain, 7:15 Eastern. MPC member Broadbent speaks. And then Canadian and U.S. Kind of dominate the 6:30 or 8:30 Eastern hour. Employment change for the CAD, unemployment rate for the CAD. U.S. dollar has average hourly earnings month end, non-farm employment change, and unemployment rate. So again, unemployment is one of those things that can affect the currency and the economy equally. So, an analogy we like to use is just imagine the economy, there's this eagle that's flying into the sky, and that eagle represents our country, and the right wing is the economy, and the left wing of this eagle is the currency. There are some things that will affect one of those wings and positively, and affect the other one negatively, and vice versa. The interest rate increases. So when the FOMC increases interest rates, which strengthens the dollar, when the dollar goes up and interest rates are increased, that means banks make more money for just sitting on their money than they do to lend it out. So to lend it out, they want collateral, higher interest rates, or better credit, all these different things. And so what ends up happening is those that may very well have been able to qualify for a loan prior to that increase may not be able to qualify anymore. So you're having less businesses getting started, less vacations, less car purchases, home purchases, and the like. So that affects the economy negatively, but the currency positive. Unemployment affects both equally. Low unemployment is positive for both sides of that eagle, right? Both wings of that eagle. So if it soars high, right? It's good for currency and it's good for economy. High unemployment does the opposite. It's bad for currency and bad for economy. Okay, we don't want people to be unemployed. As a society, we shouldn't want people to be unemployed, right? Because that affects all of us, not just the individuals that are unemployed. So any kind of, and this is my stance, you may have a different stance, but any kind of subsidies that encourage people to stay unemployed is a very bad idea, not just for the unemployed, but for the community at large, for everyone in the United States, right? So here, this is a positive thing if the forecast is that we will see a lower unemployment rate than what we saw previously. That is a positive thing. So if it's positive, then, and it comes out, actual comes out the same as forecast, then that would be positive for the U.S. dollar, right? If actual came out lower than the forecast, that would be really positive, exponentially positive for the U.S. dollar. Okay, so keep that in mind, but again, it doesn't always necessarily mean that the announcement is going to reflect what the market does. The market, even if it's supposed to be positive for the U.S. dollar, could still cause for the U.S. dollar to lose value, even if it's momentarily, and then come back. And a lot of times you'll see what they call like a three wave, right? It goes up, or in this case it would go down, go up, and then down again, or the other way, right? Go up, and then down, and then up again. And sometimes this can happen within 1 hour. Sometimes it'll happen within 20 minutes. And it can be really, really volatile. If we go back to some of these examples, let's just pull this up really quick, because I want you guys to be aware of this stuff. I want you guys to start utilizing these tools for your everyday trading, because it's going to keep you out of situations that will cause for unnecessary emotion. But I want to show you guys something. Let's go to, and I like using 2015. We can use 2020 as well. But I like using 2015 as an example because it's just a very exaggerated example in a lot of instances. So in 2015, we had these situations sometimes where we would get these huge spikes like this during an announcement, right? And that's 390.4 pips in 1 day, by the way, okay, just to be clear. And you'll notice that all the other candles, next to it and around it are significantly smaller in size, right? Look at this one. This one is 516 pips. That's 1 day. 1 day, 516 pips. Look at this one. 459 pips. There were some big stretches, right? And a lot of this could very well have happened in a small period of time, right? I mean, we're looking at a 1 day candle, so we're thinking, well, it took all day to do that. No, a lot of times that could very well have been done within just a few, if not one, candle. Okay, let me show you. So this is the day. Let's go back to the previous day, which is here, and then let's click forward. Let's see, do I have candles here? Yeah, okay. Let's fix that. Okay. So this is the end of that candle, right? So let's go into the next day. So where we saw the big drop, where did that go? Or the big increase, whatever it was. Oh, we're in 17. I don't know how we ended up in 17. Let's look at this candle right here. Okay. So if we look at that candle right there, let's go back one. Okay. That's why it's not linked. All right. Goodness, why is it so complicated for me today? Okay, clean chart. Nope, that's why. Okay, that was 2017. Okay, I know what I'm doing now. Okay. So right here, scroll position. Oh, that's only going to 17 as well. That's why. Dang it. My goodness. Okay. I'm taking a moment to do this because I want you guys to understand how important this is. There we go. Okay. So this is the last 1 hour candle of this 1 day candle, right? So 1 hour of this is here. You can see that there. So the first 1 hour will be the next click over on this chart right here. This is the 1 hour chart, and this is the 1 day chart, right? Okay. So we know that it drops down, and let's see where we get any kind of significant drop. So right there, that moved 150, 150, 240, 396, 508. So right there, we saw those moves occur, right? Immediately, we saw 150.8 pip drop. Next candle, more and more, and then look at this drop right here. This is a 235 pip drop. Okay, so let's look at that for a moment on a 5-minute chart, because I want to explain to you guys something. So let's see where most of that happened. So initially, there's only about 9.7 pips there. 33, 57. See if there's anything significant. This is slow and steady on this one. I want to find one where we get a fast drop, because what happens in these really swift drops is, let's say for example, let's find one here. This one is likely, yeah, look at this right here. Okay, right here, this candle moved up 153 pips. So from here to here, that moved up 220 pips. Okay, and 3/4 of that, right, was just right here in this 1 hour. And then the rest was over the course of the rest of the day, right? So this whole hour right here, this big green candle right here on the 1 day, most of that was done just right here. Okay? So let's see what that looked like on a 5-minute chart, so we can see how long it took to get 100 and some odd pips up. 150, right? Right there. That's only 12. That's 30. That's 50. That's not right. Oh, because we're not. Okay, right there. All right. So that initially 2.8, not much there. 6.8, 11.5. Right there. That 5 minutes. This 5 minutes right here, it shot up 58.3 pips, which is no surprise because this is the 6:30 candle. This candle is what happened at 6:30, right? So I want to show you. Let's go to clean chart. It started right here. It went down 2.9 pips and then shot up 58.3 pips, okay? Now, let's replay this because I'm certain that this is going to be a firecracker. And I might even want to go slower than that. Yep, okay. All right. So let's see how long it took before it just kind of shot up. And so when it shot up, how long it took to get as high as it did. Okay, so let's say that we were trying to sell right here, or you know, whatever it may be, and we have our stop loss 5.7. Let's just say 6.20 right there. Let's say that's our stop loss. Okay. So this is going not full speed, so this is just slower than a second per, it's 0.9 per second, so it's just slower than a second. Come on. It's probably going to happen, honestly, it's probably going to happen towards the end of this candle, maybe few seconds left on this candle. It's 2 minutes, 1 minute, 50, 40, 30, 20, 16, 6. I'm going to slow it down. Actually, let's try to get to right. Okay. Just want to time, see how long it took to shoot up. Let's say our take profit was, you know, down here 5 pips or something, right? So 5.20. 18 seconds, look. So we know how big this candle is, right? 15 seconds. So we know in the next, right about now. Watch. Boom. 1 second. It took 1 second to go from here to there. 37.8 pips. 1 second. Okay? So if your stop loss is right here and the announcement comes out, what can happen, depending on your broker, and this is 9 out of 10 times this is going to happen, depending on your broker, but 9 out of 10 times this is what's going to happen. You will get taken out as soon as this candle digresses or stays in place long enough. So your stop loss is right here, 5 pips away. Okay? But that blast right there made it so that you don't have the ability to sell your position because nobody's taking it. There's no available out right there, and it could very well have just blasted past it and your broker didn't pick it up until there. So instead of a 5 pip, let's just say you were going for a 2% trade here, okay? And let's just say you have a small account, $2,000. By the way, this is not our topic today, but this is very important, and any chance I get to cover this, I do. Let's say you have a $2,000 account, so you're risking 20 bucks. No big deal. Or sorry, $40. Because $20 would be 2% or 1%. $40 would be 2%. Right? Okay. You're risking $40 and 5 pips. So this is simple, right? You take out a calculator, and you say 40 divided by 5, and each pip is worth $8, right? $8 5 times is $40. So that's a 0.8 lot size. 0.8 lot equals $8 per pip, right? $8 a pip. And it blasts past in a second, and now it is, from your entry, 37.7 pips. So let's just call that 38 pips. Okay? 38 pips. This is a real thing. This stuff happens. 38 times $40, or sorry, times $8, because each pip, right, is $8, 38 times. $304. $304, okay, is not 2%, right? It's 15, closer to 15% of your account gone. 15%. If you were doing 2% per trade, 2, 4, 6, 8, 10, 12, 14, 16, roughly it would take you 8 trades, around 8 trades, back-to-back losers, to lose 15%. And because obviously after every loser, your account balance is lower, so 2% of the lower account balance, so it's just not, 2, 4, 6, 8, 10, 12, 14, right? It's not straight across. So that is, 15% is about 7 or 8 trades that you would take to lose 15%, but now you lost it in just one trade, and there was nothing you can do about it. You can cry about it all you want. It blasted right past your stop loss and took you out. You can take it up with the broker. Sometimes they'll be nice and do something for you. Other times they'll just say, hey, that was the increase in the spread at that time, and so you lost. And that's it. But believe me, you're not going to be able to get that money without a fight, and you may not be able to get it at all from the broker. Okay? That was just 1 second. So let's keep on playing here and see how much more it does. Look at that. Boom. And you may not have even been pulled out until after it pulled back right there, right, which would have been even further, right? So we're talking about maybe, 45 or 50 pips, right? So closer to, $400, right, which would be obviously 20% of your account. But did you see how fast that happened? Literally 1 second, and it just blasted up, right? I mean, it just took off, and nothing you can do about it. And this is, by the way, this stuff is taught in demo, right? When you're taking a demo trade like this, that demo trade will stop out right there. It will come out, and it'll take the loss right there in demo. In live, nope, there's slippage, there's first in, first out rules, there's other things that are different than demo that are like this. These are the situations, specifically, these situations are what make the difference between live and demo, okay? Now imagine for a moment if, and we did a little skit on this a couple weeks ago with Jared the Jedi and my business partner Tim Coughlin, right, where Jared was talking about breakout trades, right? And obviously we know that breakout trades are garbage, but for those of you guys that don't know, here's the thing, is that in demo, if I had a pending trade right here, right, let's say that I wanted to try this straddle trade strategy, right? And so here's how a straddle trade strategy works. Let me pause play. Okay. Now, I know the announcement's going to come out, at the top of the hour, which is in 5 minutes, and I have a pending trade, right? So this is not a market execution. A market execution is when you press the buy or sell button, right? You just press the buy or sell button, and that puts you into the market. A pending order, right? So if I went to new order and I did a pending order, then I can do a buy limit, which means as the market goes down, when it gets down to a certain level, I can say, okay, buy. Or I can do a buy stop. And a buy stop says when the market gets up to a certain level, buy, right? And then a sell limit would be if the market was going up, I would say when it gets to this line, sell. Or a sell stop that says when the market starts going down, when it gets to this level, put me into a sell, right? So a buy stop is what, and so here's what you would do. You would have a pending entry for a buy stop and a sell stop, okay? So then I would say, okay, here's my buy stop. In other words, when it gets to this level, put me into the trade, right? And so let's just say, let's see, yeah, that should be it, okay. So let's just say we're going to say right here, right? When it gets to this level, put me into a buy, okay? And then when it gets to this level, or if it gets to this level first, put me into a sell. And then we can put what's called a trailing stop. And a trailing stop says, I'm going to trail this trade as it goes up. Let's say I have a 10 pip trailing trade. As it goes up, I'm going to have a 10 pip stop loss that follows it until it comes back by 10 pips. So if it shoots up 100 pips and then comes back 10 pips, then I make 90 pips, right? And it does it automatically. That trailing stop just follows it, okay? Now, people will teach you that this is a good way to do it, a good way to trade, because as the hour gets closer, that's basically what you do is just move your entry, your pending order, closer to the candle that's moving, as close as you can to it, right, without actually getting into the trade. So you just kind of move this a little closer and this a little closer, because you don't know which way it's going to go, right? And you keep on doing this. So let's get down to the last couple seconds, because now we know where it happens. So 5, 4, 3, 2, okay, almost there. So let's say, okay, let's say we had it up here, right? Okay. And we got 20 seconds. So with 20 seconds remaining, we're really starting to move these closer and closer, right? Closer and closer. And we already have it set up, so it's just going to take the trade right there. So it would have right there. That's 1 second. It took 1 second, right? In demo, it accepted your trade, okay? You're now in the trade at 1.11618. And you are profitable right now. Within a second, you're profitable 50 pips, okay? And then as soon as it drops back by 10 pips, so that's 7, yeah. So 1.12074, 1.12064, 0.64, just that much, right? Let's just say we're going to trail it by, let's just say 30 pips, right? 1.1207 or 17. Sorry, what was it? Cancel. 0.74. So 19.64. Sorry, so we can do that after all. 1.12. So that would be 1.11974. 1974. Okay. 2074. Okay, that's 10 pips. So it'll stay with it. So if this moves up another 15 pips, then this will move up another 15 pips behind it by 10, right? So that moves up 15 pips, but then, and then this moves up 15, this line moves up 15 pips with it. But as soon as it comes back down 10 pips, it touches that and gets you out wherever it is, right? Okay, so let's just see where the digression happens by about 10 pips. Oh, so next candle. Okay. Adjust. So that's the high point. So that is now at the high point, and 10 pips from there, 112.162, so 112.062, 112.062. And if it moves any higher, then obviously this line right here, make this line orange, this orange line right here is going to follow it, right, automatically. So this looks really appealing, right? And in demo, it works perfect. So let's keep on going. Yep, right there. So you're out of the trade, okay, because it came back 10 pips from its highest point, okay? So then you made roughly 50 pips, right? And so now you're all excited. Man, I just made 50 pips, and I had a 1.0 lot size in, 1.0, right, because they're going to encourage you to max out your leverage and times 50 and just put a 0 behind that, and you made $500. And it took you a minute and 10 seconds, or 20 seconds actually. It took you 20 seconds to make $500. And now you're just so impressed, right, that you go and get a loan on your house. You go and borrow from your friends and family. You're showing them your demo account that has millions of dollars in it that you made in a week, or hundreds of thousands of dollars that you made in a really small amount of time. And you convince family and you show them, you know, the examples, and they're all impressed. And so they're lending you money, and you're borrowing and begging from everyone, right? You put it into the live market only to find out that you don't really know how to trade. And you don't know about slippage, and you don't know about leverage, and you don't know about any of these things. And so you think that your trade is going in right here, but what actually happens is as it moves up and then starts to pull back, then buys become available. If there's nobody wanting to buy within here that was in line before you, then you get in. But guess what? You get in up here. Now you want it to come back, at that point, if it starts to go up, then you can start making profit, right? But you didn't get in down here, okay? And so remember we were talking earlier about that three wave. Sometimes the market will go up and then down and then up, right? Or sometimes the other way. And other times it'll just go up and then down, like it did this last Wednesday, right? This last Wednesday it did the opposite, right? It went down because we had the FOMC announcement. It went down and then it went up. So it went shot down really fast, and then boom, went up, right? So if that was the case, in this case, if it had gone up and then put you into the trade and then started going down, you would have just lost the trade. But if it did it fast enough, the same rule applies. You may not have gotten out where you wanted to, so you end up losing, and you think, oh, maybe that was a fluke, maybe I did it wrong. You do it again and again because you had that dopamine effect. You had that thing that happens when you win a jackpot in Vegas, or when you're hitting on a girl and she gives you your phone number, or when you are flirting with a guy and he's interested in you. All these different things, you know, that you've had throughout your life that cause for you to have that dopamine effect, right? That occurs in things like day trading. And it's a dangerous thing when it occurs because of something that you shouldn't have been doing, right? Now, when you do it in demo, it looks really impressive, and if you don't know any better, then you're sold on this idea, and you have that dopamine effect, and now you are committed to following through with this. And all that borrowed money that you have and whatever money you paid for some con artist to tell you about this setup, now you're in the market with live money, and you could very well lose every penny of it, which the con artist doesn't matter because they've already got your money. It's not like they're keeping any of the money that you lose in the market. They're just charging you to teach you some garbage. Okay, and that's exactly what it is. And believe me, we see these companies pop up really often. And, I mean, not like every year, but, you know, we've been doing this for over a decade. So over that decade, we've seen 4 or 5 of these companies pop up. So that's like one every other year, right? And they flood the market with advertising. They get a whole bunch of people to sign up for their program, and then they're gone. They're out of business, and they run away because they know as soon as those people realize that we're full of it, we're in trouble. And that we're going to have SEC or CFTC or some other government entity up our tails. So let's just grab the money and get out. And then we'll come back under another name later, or another company does the same thing. It's garbage, and it's intentionally taking advantage of you, intentionally cheating you out of your money. Okay? So don't fall for this stuff. More importantly, if you see something like this online, just know that it is absolute garbage. Just know that there are no shortcuts. Okay? You might be able to win a trade or a handful of trades like this, but trying to do this often enough and you're going to lose everything. the same way you made everything is the same approach that is going to lose you everything. Which is why before we allow anybody to come into our Trader University, we tell them, look, if you've traded in the past, there may come a time where we ask you to forget everything that you know. If you're unwilling to do that, then this is not a good fit and you should not proceed with us. Right? Because we know that those same things that traders hold on to so dearly, because at some point they had some success with it that made that dopamine rush occur, that they are unwilling to let go of, is the same thing that's causing for them to lose in the market, and they will never progress in the market because everything revolves around that. So you'll say to yourself, well, it didn't work that time, and it didn't work another time, and now I'm almost out of money, but if I can re-up, I think I got it figured out, right? And what do you sound like now? You sound like a drug addict. You sound like a gambling addict. You sound like somebody that's got a problem. You are not a professional. You got conned, and that dopamine had an effect on you to the extent that now you're putting everything on the line for a hoop dream that will not come true. Okay, that is just the way it works out. That's just the way it is. Can you get lucky? And perhaps they work out for you? Yeah, but that luck is going to run out eventually. So if you did it once, great. Quit trading, never do it again, never day trade again, and walk away with money in your pocket, right? If that's how you intend to trade. Great, you'd have a 100% win rate. You did it once, it worked, now walk away. But if you intend to be a professional day trader and build wealth and get those things that you're looking to get, time freedom, retirement, early retirement, retire when you're not 80 years old, right? Travel more often, have more time to spend with family, with grandkids, with children, with spouses, by yourself, whatever, travel, whatever it may be. Send your kids to better schools, have a bigger house, a nicer car, right? Not have to worry about paycheck to paycheck anymore. Know that finances are taken care of, but not only that, you're doing it in 30 minutes to an hour a day, so you have the rest of your day to do whatever you want. That is freedom. Regardless of whether the market is going up or down or sideways, you know that you can make money. Nobody can fire you. You've got complete and utter control of your financial trajectory. That is how you were made to be. That is how you were made to be. Understand, you deserve that. Money's not this amazing, wonderful, incredible thing that some people deserve and other people don't. You can just have it. You can just have it. If you have something that can get it for you, you get to have it. Okay? So remember that. It's a very important lesson. Okay. And I want you guys to remember this garbage. And that's why I took some time to show it to you, because I want you to be aware of that. All right, let's get to this. Okay, so our indicators work, in a couple of ways, and we've talked about this before. And so we're going to look at the illogical nuances of the thick orange line, the TNT, okay? And what's really amazing about these indicators is that, and we've talked about this a couple sessions ago, is that sometimes when the lines point, down, right, we want to trade down. And sometimes when the lines point down, they're telling us to trade up. It's illogical. It doesn't make sense at first glance. Now, the thick orange and the thin orange on the TNTs up here, these are called the TNTs. These are the major minor, and these are the pressure. Now, most of our setups will include, two of these, not all of them usually, or just one of these, but usually not all of them. This particular one, this particular indication that I'm going to show you is not always by itself a setup, but it's a great indicator to tell you if, to verify, right? Should I trade up or should I trade down? And sometimes that indicator alone will tell you, wait a minute, right? So in this example right here, the thick orange normally at its base, not normally, but at its base function, when it points up, it's indicating up. Thin orange, when it points up, it's indicating up. Blues are inverse, so when blues point down, they're indicating up at their base function, right? And so if this one's pointing down, it's indicating up. Okay? Now, illogically, which is, in my opinion, more valuable, when it points up and you've got a red candle, that is more indicating down than it is up. Now, it doesn't always do that, but it's consistent enough that coupled with any other indication, you can get a really, really consistent 70, 80, even 90% win percentage with specific risk reward and risk percentages, right? Or win percentages. So the reason for that is just kind of the nature of the thick orange line. All right. Now, the thick orange line increases in value or decreases in value when it's pointed down to indicate that it's kind of getting to its end of life, right? And its end of life is negative 100 at the bottom or 0 at the top. So this goes from negative 100, and they're always negative, so negative 100 all the way to 0. So it's not like negative 100 to positive 100, because then 0 would be in the middle. Instead, it's just negative 100 to 0, or 0 to negative 100. Right? If you're using the Green Chart 2, our web-based version, it would actually kind of be reversed. It would be 10 on top and 0 on bottom, not negative and not 100. So it would be 10 or 0. Okay. Now, as it nears that, it's just saying that indication, that sell indication right there, is gassing out. Okay. Now, if that is saying this sell indication by way of what's in the market is starting to gas out, right? What is it saying then when it starts to go up, right? And you can see that it didn't really move very much in value, right? Look, so right here it moved, actually 86.6, it actually did here. 86.6 all the way to 70, so it lost about, I mean, if we're just looking at it in terms of these values right here, that's about 16, right? So 86 to 70 is about 16 points in value. It lost 16 points in value, but it didn't move up. It went down. So it's just exhausting. Whoever's trying to buy here, whatever miners are trying to buy there, the majors are taking advantage of that. So as the miners continue to put counterweight, the small and retail traders or smaller trades continue to put counterweight in the opposite direction, that gives the bigger institutions and other more wise retail traders the ability to continue to short. So then this is telling us that we still have some sell available in spite of the fact that the thick orange is up. Now, one thing that does help is when we have maybe pressure in our favor or majors pointing in our favor, which in this case we do, and sometimes that's not even necessary. But here we would be looking to more favor a sell trade than we would a buy trade in spite of the fact that this is pointed up. Matter of fact, because that is pointed up. Because this is illogically telling us, right? It is telling us you should favor the sell. That's what it's telling us by pointing up. When we can read it, we understand that, right? Think about other languages. There are words in other languages, and as you start learning those words, you start to realize that sometimes if there's another word that sounds like that word, maybe it's a root word within that word, that it means the opposite, right? And we see that in English too, right? We could have a word that has a root word in it, but in combination with other letters, it becomes the opposite of what the root word means, right? And so as we become more fluent in understanding the indicator language, then we can pick up on some of these subtle nuances and act accordingly. So in this case, we would sell. And you can see the market started to sell. Now, one thing that's really indicative of this particular illogical setup is if it continues to point up, a lot of times you can continue to sell, right? And you got to be cautious of that because time of day and things like that, it may not move very much to the sell side. But once it starts pointing logically, it's now pointing. You see the thick orange line is now pointed down, and there's a red candle. That's it. You don't want to try to push that anymore. It may still go down, but it's likely that's done, and you're likely to start moving the other direction after that. And we did a little bit, and we probably moved more up than we did down there, 2.9. Yeah, it's really a low volume time. But you get the idea. That's kind of the indication that the move has run its course, is that it's pointed down and now there's a red candle. So it becomes logical. Okay. Now, right here, we have a very similar situation. Thick orange is up, and we've got another red candle. Now, if the candle is a doji, which is like it ends about the same place that it starts, so it looks like this, more like a cross, you know, like a wick, and then the body, and then a shadow, right, kind of like that. We're not going to use those, right? So it can be green, it can be red, but let's just stay away from those. So if it makes a doji, that's what that candle is called, where it ends about the same place it starts, then with this setup, we just skip those. We just wouldn't use it on those. Okay, so right here, again, thick orange is up, and we got a red candle. Here again, we have majors favoring. Green is on bottom, so we do have some other indications that are telling us that there's some favor to the sell side, to the short side. And right there, we get something a little more impressive, right? That one moved up about 1.6 pips, and then it came down about 8.8. So that was good. All right, so let's look at another one here. We've got here we've got the opposite, right? We've got a green candle, and thick orange is pointed down, right? And so the same rule applies here. We are going to look to buy, because when it's a green candle, then we're looking to buy. When it's a red candle, we're looking to sell. So when the thick orange disagrees with what the color of the candle is, then we go in favor of the candle. Not because we're using the candle, but it's just telling us that the market moved up as the thick orange line moved down. And that's the thick orange line's way of telling us, look, traders are trying to do this one thing, and the bigger institutions are doing the opposite, and there's still room because traders are still trying to push down, or we haven't hit their stop loss yet. Okay, and so then we look for an up. Now this one initially came down 5 pips and then up. Now you'll also notice that we were kind of sideways here and not really pointed up. And so again, sometimes those things will have an effect, but let's look to see how this played out. So initially it kind of moved up and down, but not very much in either direction, right? Low volume time, and then it comes through and starts to push up. So you see that, and then right here, so right here, by the way, the move is the thick orange. We wouldn't continue to buy, first of all, because we hadn't gotten a buy, but we also have a red candle, and now thick orange is down with a red candle, so we wouldn't sell either, right? We just do nothing in that situation. And right here, it started to pull back up. Okay, so let's look at this example here. Again, we've got thick orange down with a green candle. Majors this time are actually pointed opposite of where we're looking to go. Pressure is pointed up, but green's on bottom, right? So we do have some things here that could very well affect us. Now, one thing we do have going for us is that we are at a negative 100, so we're getting pretty maxed out on the thick orange value already. But right here, this would be, and honestly, if we were looking for another form of validation, this would be a less clean example. Matter of fact, we may not even take that based on the thick orange, the green candle, and looking for validation, because we don't have a lot of validation and other indicators telling us that this could go up, right? But again, we can see that, so let's go forward, and we can still see that the outcome was that the market moved up versus down, right? So let's look at this last example here. And right here, we actually have a couple things going on. Thick orange is up, right? Red candle, so we're looking for a sell. But we have a hydra, and if you guys had attended one of our previous sweep sessions, I can't recall which one it was, but we talk about the hydra. In addition to the hydra indicating up, we just had green cross on top of red. It is sideways, and green is on top of red, which would indicate we should see some buy or long movement, right? But right here, that thick orange and that big red candle is telling us, well, you may want to be cautious about this one. You may not want to take that one. You may not want to bite off on that one. Or if you do, wait, right, and wait for a better position. And this one, it does go up a little bit, 3.4 pips. So depending on what you were going for in profit with that Hydra, you could very well have still scalped that and got out of that trade. But then it went down 14.3. So it definitely favored the down than it did the up, right? And now thick orange is pointed down, so that would nullify the illogical sequence of the thick orange. And there are some other rules there that you can really dig into, like after it goes logical, once it gets to like negative 100 down here, or if it's going up like this, once it gets to 0 up here, you'll notice that you can start taking trades in the other direction again. And so there is quite a few sequences to this particular indication. So it's not a pattern, it's just an indication, right? There are some really intuitive sequences to this indication. When you learn how to read them, they become really, really helpful in either verifying trades or invalidating trades, or maybe you're just going to wait for a better entry. So it can really help increase your win percentage, right, and keep your risk to reward the same. So if you had like a 70% win percentage and you had a 1-to-1 risk to reward, your stop loss is the same as your take profit, and you use stuff like this, you could very well increase your win percentage. Even if it went to 75%, you can see that that would be a very significant increase in your profitability with a 1-to-1 risk to reward ratio, or even a 2-to-1 going to 75%. So there is a lot of value to having these types of indications and being able to read them. Okay, so I want to wrap up the same way we do all the time, and that is to let you guys know about our Trader Lite program. Of course, this is how we vet people to trade our corporate funds. So right now we are not doing it for free, but for $10 you can sign up for this program, which is normally about $800 and some odd dollars. And that $10, we will donate 100% of it to our charity partners, Feeding America. Guys, this $10 creates 100 meals. I know we've talked about this last week, but I just want to show you guys, it's pretty incredible. That $10 creates 100 meals. So if you know someone, if you're here and you're already trying the Trader Lite, and you know someone, send them to us, right? Have them donate the $10, go through the process. That can help you build your trade circle. If that person is a good fit for us, we accept them into our university, and they move forward with us, then, and you move forward with us, then you have somebody as an accountability partner or to bounce ideas off of. Two heads are better than one. They'll notice things that you don't, and you'll notice things that they don't, and you'll be able to create a trade circle. So definitely send them to the site, daytradesmart.com/free. It's not free, but we're just reusing the link. So it is $10. You're going to get access to our indicators, the indicators I was just showing you, and you're going to have access to them remotely anywhere from your desktop to your mobile to your tablets. You're going to have access to them. On-demand training videos. You're just going to be able to watch those training videos as much as you'd like. Weekly continued education webinars where one of our coaches will go over a topic and help expand your knowledge of day trading. And then we'll trade with you. We do webinars where we trade with our members. Take trades. You can take those trades along with us. Of course, you can communicate with other traders on our mobile and desktop app, Trader Chat. And then, of course, you're going to get all the real-time alerts, so you can start taking those alerts trades and learning about those alerts trades. Plus, you're going to get 2 one-on-one coaching sessions with a professional day trader. This is huge, huge, guys. Go and price what just this costs. Believe me, even if we charge full price for the Lite program, $800 and some, that is maybe a tenth of what you would pay for 2 one-on-one sessions with a professional day trader. Believe me, go look into it. Don't take my word for it. We don't want you to trade with real money. Do not trade with real money on the Trader Lite program because you don't know how to trade yet. We want you to be able to see if this is something that you can do, if it's valuable, and if it meets a personal need. We want to see if you're a good student, if you show up to appointments, if you're teachable. So go to the link, daytradesmart.com/free. Sign up for the Trader Lite for only $10, and we'll get going. We'll see if it's a good fit. Now, again, our Trader University is enrollment to our Trader University is anywhere from $8,000 to up to $23,000. So if you're just curious about day trading, this may not be the right fit for you. But if you're serious about changing your financial trajectory, you're definitely in the right place. You found the right place. Congratulations. Right? All of our programs, the 8,000 all the way to the 23,000, come with a minimum of 6 weeks one-on-one coaching with a one-on-one coach and a funded account when you're done with your coaching. You get a funded account and you start trading with live money and keeping the lion's share of the profit. We look forward to working with you guys. Thank you guys for joining us again today, and we'll talk to you next week. Until then, happy trading.